Welcome to the deep dive. Okay, so you sent over a pile of sources on this. This absolutely wild ride in the crypto market recently. Just completely abrupt volatility.
Yeah, seismic is probably the right word. It really tore through the system, especially where leverage was high.
And it wiped out all that optimism pretty much overnight, didn't it?
Instantly.
The numbers are just kind of hard to grasp. We're talking over $19 billion liquidated globally in just 24 hours. That's from the October data you highlighted.
19 billion. And analysts are calling it historic for a reason. It's apparently 4 times bigger than any previous liquidation event like this.
4 times. Wow.
And that $19 billion figure, it's a raw measure of just how much leverage got purged. This wasn't people deciding to take profits. This was forced selling, a cascade.
Yeah.
It really showed how brittle things had gotten just days after hitting those new highs.
Right. So our mission today for you listening is to cut through the noise. We want to unpack what triggered that geopolitical piece, and then dig into whether this is like a healthy shakeout, as some are saying, or maybe something worse. And how does this all fit with regulations finally getting serious?
Lots to cover there.
Okay, let's unpack this. So first up, the trigger. The timing here feels, well, almost too neat, doesn't it?
It really does. The crash kicked off just 2 days after Bitcoin hit a brand new all-time high.
Right when everyone was celebrating.
Exactly. And it lines up almost perfectly with this big political announcement. The sources point to that sudden threat about 100% tariffs, geopolitics hitting hard.
And what's really striking is how fast that geopolitical risk translated into crypto prices. Instantly.
Yeah, and the key reason it blew up so much was the market condition itself. It was primed for it. You had, as the analyst put it, too much leverage and not enough liquidity.
Meaning no big buyers ready to catch the falling knife.
Pretty much. There was no shock absorber. So when the automated selling started, based on breaking those price levels, there was nothing to stop it turning into a full meltdown.
Okay, but hold on. If the market had too much leverage, doesn't that kind of point a finger back at, the exchanges or maybe the regulators, especially with all this talk of new rules we'll get to? Shouldn't something have prevented that level of risk building up?
Well, it definitely highlights the limits of oversight when things move this fast. I mean, sources say the big drop started literally seconds after key technical levels broke.
Yeah.
Seconds.
Wow.
That forced liquidation cascade just rippled through the major platforms. It was incredibly fast and just hit everything.
And not evenly, right? Bitcoin took a hit, about 10% off its high, which maybe shows some underlying strength, I guess?
Relatively speaking, yes.
Yeah.
But the altcoin market, that got absolutely hammered.
Yeah, you pull out the XRP example, down almost 20% in a week. Fell to $2.43, breaking way below its recent range.
The nearly 20% drop, that shows you just how savage that leverage washout was for alts. For a lot of retail traders, that's not just a dip, that's game over. Liquidation.
Which, that severity, it brings us to this next big question. Was this just a random market panic triggered by news, or was it maybe more calculated? One analyst you flagged called it a carefully designed move.
Yeah, and there's some pretty compelling circumstantial evidence pointing towards orchestration, at least by some big players.
Okay.
Market watchers spotted this really suspicious pattern. Apparently, just hours before the crash really took hold, some large holders, the whales, they reportedly opened over $300 million in short positions.
Wait, $300 million in shorts? Just before it all went south.
That's what the reports indicate, placed right before this supposedly random event.
Okay, that smells fishy. The lesson there isn't just that some traders got lucky, is it? It feels like the system, the leverage, rewards people who can engineer these collapses.
That's precisely the argument. These huge short positions lined up perfectly with 2 things happening: liquidity drying up and key technical support levels breaking. The timing is just too precise to ignore. It strongly suggests these, let's call them top-tier traders, saw the breakdown coming, positioned themselves to profit massively from it.
And then their own selling maybe helped trigger the wider cascade.
It certainly could have contributed momentum. They effectively surfed the wave of automated liquidations, benefiting from that $19 billion wipeout. The key insight for you is that it looks like they were way ahead of the curve before retail even knew what hit them.
Okay, if the timing suggests it was engineered, at least in part, what was the point? Was it meant to just crash everything, or was it more like a reset, a cleanse? Yeah. Here's where it gets really interesting. What does this massive liquidation actually mean for the bull market? Is it over?
Well, a lot of the expert commentary is leaning towards the shakeout theory. They're framing it as kind of a necessary evil.
Necessary how?
The idea is that this big flush, as they call it, successfully cleared out most of the risky, over-leveraged long positions. It removed the excessive leverage.
Okay, sounds neat for the big institutions maybe, a reset. But if you're the small investor who got wiped out, doesn't shakeout sound a bit like a polite term for manipulation?
Oh, absolutely. You have to acknowledge the pain that causes for individuals caught on the wrong side.
Yeah.
It definitely feels like manipulation to them.
Yeah.
But looking at it structurally, the theory is that removing that froth, that excessive leverage, actually sets the stage for a healthier market going forward, a market reset.
So the assets get cheaper.
Exactly. And then the better hands, the institutions, the whales, they can supposedly step back in and buy assets at lower prices, repositioning themselves.
And you mentioned Bitcoin holding up relatively well, only 10% off its high compared to the altcoin carnage. Does that support the reset, not collapse idea?
It does lend some weight to it. It suggests the fundamental demand or belief in Bitcoin might still be there,
right?
But the system was just incredibly sensitive to these sudden shocks because of the leverage. This whole event basically proves crypto is acting like this hypersensitive barometer for global risk. You get a sudden geopolitical shock, like a tariff threat.
And boom.
Boom. Instant severe reaction because of all that leverage sloshing around.
Yeah.
It's like the canary in the coal mine for global macro shifts, reacting faster than almost anything else.
That's a really good way to put it, a risk barometer, which forces us, I think, to look beyond just the price swings, crazy as they are, and consider the underlying structure, because all this turbulence is happening right as the crypto world is making its biggest push ever towards regulatory clarity. Globally,
yeah, if we connect this to the bigger picture, that regulatory landscape is changing fast. And the whole point is meant to be stability, right? To build more robust financial plumbing for the ecosystem.
So what's happening there in the U.S., for instance?
Well, in the U.S., 2025 seems to be marking a real shift, moving away from that older style of regulation by enforcement. Now the talk is much more about creating clear rules.
To encourage institutions.
Exactly.
Yeah.
Accelerate adoption. Things like the predicted approval of staked ETFs. That's part of making it easier, safer for big money to come in.
And Europe's already made a big move with MiCAR.
Oh, yeah. MiCAR is huge. The markets in crypto assets regulation, it went fully live across the EU in December 2024.
Creating one set of rules for everyone.
Essentially, yes. A unified framework, replacing that old patchwork of different national rules. It's a massive step towards harmonization. Although we are seeing differences in how fast countries are actually implementing it. Germany, Ireland, they've apparently shortened their transition periods to just 12 months. They're moving quicker to get firms fully compliant.
Okay, so Europe's pushing ahead. And globally, what about things like money laundering? FATF.
Right, the Financial Action Task Force. They're definitely tightening the screws globally on anti-money laundering, AML standards. The big push now is for the travel rule. It means crypto transfers need to include sender and recipient information, basically bringing them in line with how traditional bank transfers work, sharing that data.
Okay, makes sense. But hang on, didn't your sources also say that something like 75% of countries surveyed are still lagging way behind on actually implementing those FATF rules for crypto?
Yes, that's the rub. That's the core tension here, isn't it?
So the rules are there on paper.
Right. Regulatory clarity is coming. It's designed to create market integrity, stable plumbing. But the reality on the ground, the actual global implementation, it's slow, it's patchy.
While the market moves instantly.
Precisely. Market forces, especially leverage and potentially coordinated moves, they still dominate the short-term price action because the global regulatory framework isn't fully built out and enforced yet. It can't react in seconds like the market can.
So what does this all mean? Tying it together, we've got this geopolitical shock that triggers a massive, maybe partly engineered leverage crisis.
Yeah.
And it happens right when the whole industry is trying to mature, get regulated, build stable foundations worldwide.
It really shows crypto has hit a scale where these big global macro events, these political shockwaves, have immediate and profound impacts.
Yeah. The tension is palpable, isn't it? You've got this slow, structural regulatory process aiming for stability.
Long-term stability.
Clashing with instantaneous, severe volatility driven by geopolitics and leverage. The structure might be maturing, but the market is still incredibly vulnerable to these outside shocks.
That captures it perfectly. The plumbing's getting upgraded, but the house can still get shaken violently by earthquakes.
So while everyone's watching the charts, asking who bought the dip, maybe around that $100 Bitcoin level people were watching,
Right.
the really deep question for you, listening, might be this. As regulation slowly stabilizes the internal workings of crypto, does that mean external factors like geopolitical instability now become the main driver of these huge market swings?
That's definitely something to think about. Where does the biggest risk lie now?
Something to mull over. We'll certainly keep tracking those drivers.
Absolutely.
Okay, that's all we have time for on this deep dive. Thanks for joining us.